Under the Hood with Dimitri and Mustafa.
What is going on, Dimitri? Welcome to Under the Hood with Dimitri and Mustafa. I hope you guys doing well. It's been a while since we had our last show, and a lot of crazy things are happening. Dimitri, what's going on in the world today?
Yeah, man, look at it. I mean, since we last spoke, it's just been a whirlwind of information, breaking news every hour out of Wall Street. But a lot of what we've been talking about is finally starting to culminate into something material that we're able to see. The entire collapse of Silicon Valley Bank, I think, would be very difficult for most to predict because of all the moving parts. It's not a traditional failure that we've seen in the past. So I think took a lot of people by surprise. I mean, this was a bank that was like the darling of the banking industry over the past 20 years here in the 21st century. I mean, everybody looked up Silicon Valley Bank. They rose, they came out of nowhere.
Yeah.
Right? They were a nothing company. Then they became a formidable threat up in the Bay Area, and then they began to spread nationwide, working mostly with VC firms, to help finance everything from crypto, all the way to the latest and greatest technology. So, something that was quite unexpected and really, it happened in 48 hours?
Yeah.
I mean, it was crazy.
So what do you think, I guess, in lack of better words, what do you think brought them to their knees?
Well, I mean, a combination. These guys, when you look at their balance sheet, they were pretty conservative in the way they managed their money. And, what happens is when you've got a year like we did last year in 2022, where the Fed funds rate went up over 6,000%, and you and I looked at the chart, a few episodes back. I think the next highest increase in a calendar year was just over 200%. So when you have such a significant increase in rates, and you're holding on to a lot of, treasury bills, bonds, notes, and mostly in this case, they had purchased a lot of bonds, so long-term money sitting out there. And what happens when rates go up? Just think about what happens to the housing market when rates go up. Houses come down, right? So you're holding on all these bonds, and the interest rates being pushed up by the Fed, and what's happening to the value of those bonds?
Yeah.
They're decreasing. So
those bonds
you've
are
got
held at 1% or...
Yeah, I mean, it depends what rate, but, for them to turn around and liquidate those, they'd be liquidating them for huge losses because of the 6,000% in the Fed funds rate that went up, over the course of the 12 months in 2022. So, now you've got an issue. Where do you pull liquidity from? Where do you get money from? And what was happening on top of it was, think about their primary borrower, Mustafa. Who are the riskiest borrowers of a bank, of any financial institution, is a startup.
Sure.
Right? Is a startup company with the, hopes and dreams. I think you've even called them dreamers in the past.
Yeah.
These people that are just dreaming and hoping that they can make it. And Wall Street, is interested in specifically, a bank in this case is interested in financing those projects, and to the tune of, potentially hundreds of millions of dollars, maybe $1 billion.
Yeah.
So, when these companies like we're seeing right now in the economy are starting to hurt, right? Especially these on the fringe, high tech, companies that, need millions and millions of dollars of have millions and millions of dollars of operating expenses monthly with no revenue. And now we're seeing a significant slowdown with the increase in interest rates, and the economy's beginning to really reflect what's been going on with these rate hikes. Right. So these companies, what's happening to these small little tech companies? They're hurting. They're going to the bank. They want their money. So deposits or DDA balances or business checking account balances began to dwindle. Well, what happened is there were a couple of VCs that really worked closely with this bank, with Silicon Valley Bank, and had a lot of their customer base. So, we talk about customer concentration, right, Mustafa, not only in the industry, but also just in terms of these are all startups for the most part. So you've got a couple of VCs that have been supporting hundreds of these startups, and now they're hearing from their customers some pain. I'm hurting. I need more money. They know that Silicon Valley Bank's business checking accounts for these companies were dwindling to nothing. So when news got out, just through, typical conversation, and then beyond that to social media, right? And all the latest and greatest technologies we have that have brought our world, brought our world closer, right? It spread like wildfire. So everyone started going and pulling their deposits out, and before you knew it, there was just no time, and the bank had to shut down.
So were these venture capitalists, they started seeing this problem, and you're saying news got out somehow from one to the next, and people start seeing that there's a potential situation here where especially the majority of their customer base were all startups. So then these companies are basically pulling out their deposits because they're expecting that thing, it's going to be a rocky road for them.
Or it already has been.
Yeah.
It's been a tough 6 months.
Yeah.
And their deposits are dwindling. And I think if you look at bank deposits in general, they're dwindling right now.
Yeah.
I think you and I had talked about, or perhaps we hadn't, but I last year, or maybe late last year, predicted we're going to have a liquidity crisis in the banking industry. I didn't expect it to happen this soon. I thought it was going to be a third quarter event, maybe early fourth quarter. That was my expectation. But look, we just saw a liquidity crisis. The reason why it's kind of was hard to predict, or I think hard to foresee, is due to the fact that it happened in a very weird, strange way.
Yeah.
This bank is taking deposits or investable assets, and they're putting them into U.S. Treasury bonds, which are, one can argue, the safest instrument you can put your money into in the world. Mm-hmm. But what they didn't foresee is the interest rates rocketing up, to the point where they are today, and those bonds losing 10, 20, maybe even 30% of value last year.
Do all banks do this or no?
Yeah, it's pretty common. It's pretty common. The thing is again, Mustafa, it comes down to concentration. Okay. And they had a lot of deposits or a lot of assets that were tied up into bonds. I don't know what percentage of their assets were, in treasury bonds, but I know it was a rare thing to see on a bank balance sheet. Okay. It was very uncommon to see that type of concentration. Most banks do what? They take their money out and they lend it.
Yeah.
This bank was a little different in that manner. But in terms of liquidity, think about it, you're so leveraged now because your bond prices have come down, and you've got no liquidity to lend. So it's kind of there's just so many things going on, but really what happened is these VCs caught wind or they've been noticing that their customers aren't doing well. And they put one and one together. If you're not doing well, you're draining your bank account. Maybe they heard of a couple of their customers pulling large dollars from SVB. I don't know. And then they started to tell their other customers, and that's kind of what happened.
So pull cash, move it elsewhere.
Pull cash, move it elsewhere. So over the weekend, then the FDIC was trying to locate a buyer, and I guess they still are. I don't know if you saw that.
Yeah.
But it appears they're still potentially, searching for a suitor to buy them out. But the Fed did come in, and there's a portion of the FDIC that is funded by banks themselves, not by public funds or taxpayer dollars. So they're going to leverage. I think that fund has over $100 billion. So they're going to leverage a sizable chunk of that to make the customers of SVB whole. Right?
Sure.
There was, I think I saw Roku had $500 million sitting in deposits at that bank.
Imagine that. Yeah.
So, you're only insured up to 250,000.
Hopefully they had more than one account elsewhere with another bank, because I mean, I don't know how they were doing payroll, because that was another thing I was hearing about, that some companies weren't able to do payroll, and I don't know how much of this is true. I haven't verified it, but there were some rumors and talks, and so there's a lot of scare out there. Yeah, but it's interesting because it looks like Silicon Valley Bank, as you mentioned, concentration, the majority of their clients are startup companies. And so if these are startup companies, would it be the same as we used to have this thing in many years back when I worked with another institution. We had a division called Technology Life Sciences. And what they did was basically, if you were a startup, like say Uber, and when Uber was a startup, and then you're going out there presenting to the venture capitalists to get some form of a interest in your company, and then the VCs or the venture capitalists would say, okay, we're going to give you 30 million, but we want 30% equity ownership in your company. Then they would take that 30 million, and then they would go to a bank like Silicon Valley Bank and say, look, we got Dimitri, one of the most well-known VCs in America, and they're a big firm investing in our company, and we need another 30 million. So then Silicon Valley Bank, or whichever bank they went to, would cough up the other 30 million, or give them a $30 million loan based on some interest rate that they negotiated. And then one of the requirement was, okay, you're going to have your deposit balances and your relationship with us, but here you go. From the sounds of it, majority of these VCs and startup firms were going to SVB for their banking needs, and I guess the risk factor is there's really no financials to base this off of. You're really looking at the startup, the VC that's involved, and what's being projected in the future.
Yeah, you got a lot of salespeople selling you, right? Trying to make you believe that the projections are going to be, are going to be spot on. But yeah, I mean, that's a risky world in itself. And then, you get a bank that's got a high concentration in a lot of medical tech companies up in the Bay Area. I know they had a lot of those, but yeah, I mean, hey, that's what happens on the, I thought it really pissed me off today, Mustafa, I got to tell you. So today I open up CNBC, and you know what I see? The market's in red. Okay. Obviously, the market sold off tremendously on Friday, and it sold off just slightly today. It was extremely volatile. The market was in the green 200 points, down 200 points, numerous times throughout the day. It just couldn't find itself. It ended just slightly down. But there was a headline on friggin' CNBC, and it said, even with the government bailout, the Dow is in the red. And I'm sitting here thinking, what do you mean even? This is a really big problem. You think the market should be up because the government covered it up?
Yeah.
I mean, it's absurd.
Yeah, it's a domino effect.
If you see something like that happen, that's a major shock to the system. You certainly don't want to be invested or taking on additional risk when you see a bank like SVB that was nothing and had traded for $600 a share a year ago and is down to zero today and has closed up shop.
Yeah.
The market's not going to be up. I mean, just because the government stepped in, does that cure all the problems? I mean, today what was going on was the news was like, okay, the Fed's not going to cut. Goldman Sachs comes out, or the Fed's not going to cut. The Fed's not going to increase rates. That was the morning thing. Then I think in the afternoon, one of the federal, presidents, office presidents of the Federal Reserve, district office presidents, came in and said that, we're going to do a rate hike most likely, but maybe we shouldn't. So the market, didn't like that either. But the thing is, you got to understand this case, and I understand it's not isolated because we had a couple other banks go under.
Yeah.
and we may have more. I understand it's not isolated, but it has really very little to do with the big picture, which is inflation,
Sure.
right? And that is the key metric that the Federal Reserve is focused on. They cannot focus on the ramifications of their contractionary policy, right? Of their fiscal tightening. They can't look at it that way. They've got to look at it as, what is the goal of my policy? My goal of my policy is to slow inflation down, period. It's not to
Sure.
stop banks from faltering. All of that, I hate to say it, all of the casualties of such policies, such tightening policies, they have to happen for the policy to work.
Yeah.
Okay, so that's what people, they don't understand is they have to, these failures must happen as a result for the policy to even work.
Well, if that
There has to be tragedy.
if that disappointed you or upset you, wait till you hear this one. So I think it was CNBC too, because I was watching some videos on YouTube, and they said, well, this is the result of interest rates increasing and banks struggling, and now it's a domino effect, and you're seeing SVB, and there's going to be more. And then one of the guys, I forgot who it was, but I was just going through all these different videos, and I heard the guys say that the Fed are probably going to stop increasing the rates, and they're going to focus on this as the primary problem, because now this is broken and they have to figure out a fix to this before they get back to. And I was just sitting there thinking about what you were saying about inflation and what the Fed are trying to do with increasing rates, slowing down inflation. But it sounds like there's a lot of mixed messages and people have different expectations. So hopefully they do the right thing, and they don't let this prevent them from making those decisions. If they need to increase the rate, they need to increase the rate to bring the economy back to where it needs to be.
Yeah, no, you nailed it and stuff. And just so you know, one of the major outcomes of this bank failure today was that the 30-year mortgage dropped like a rock. Okay, which means, what is that going to do? It's going to spur demand. It's everything the Fed does not want.
All right,
Okay.
You ready for this?
Yeah.
That makes so much sense, because today, you already know my wife is in real estate.
Yes.
On one property, 9 offers. Today.
Because they saw the rates probably come down, they went ballistic.
She said, I don't know what's going on. Now that you're connecting the dots, I wasn't paying attention to it. She said, I don't know what's going on, but on one property, they had 9 offers today. That makes sense, because people are back in.
Right away. So the Fed doesn't want that, right?
Yeah.
They don't want demand to increase in housing, especially with some of our supply challenges in a lot of markets still. As much as the real estate market slowed down, we still don't have a lot of houses on the market. So, this is the last thing the Fed wants to see. This is counterintuitive. So, and what happens is, you've got, Mustafa, I'm going to tell you right now, this is another incidence, I should say, of the Fed and the federal government fiscal policy not cooperating together in this country. Okay? That's what you've got going on here. And that's what happens when the government comes in and bails out an institution. What does that give the market? It gives it comfort.
Sure.
It gives them a scapegoat when another company fails. Oh, well, they'll get bailed out too. So the market is there to react positively. It wants to go in the green because it thinks everything's going to be okay. And that is counterintuitive to what the Fed wants. We can't have consumer sentiment increase. We need consumers to feel like they're going to go broke next week. That's what the Fed is looking for.
So, again, on that one, there's been some mixed opinions, and I'm only basing it off of, again, what I've been watching. I'm hearing some people say this is a bailout, and then I'm hearing some say, no, it's not a bailout because a bailout, and they were kind of comparing it to what they did in '08. And they said, well, we use the taxpayer money and to do X. But this time FDIC is just insuring or paying back the depositors and making them whole again. And so then on the comments section, people were basically kind of giving their perception. And a lot of people said, well, that's good. The consumers are getting their money back. The people that put their money in the banks over $250, the FDIC ones, they were going to get them anyway, right? That's part of the guarantee. But everyone, I guess, is getting their money back. And then some people said, well, that's just BS because, it is what it is. and if we're trying to improve the economy, like, why are we doing this? Constantly just flushing money back in when a bank made a huge mistake, make them pay for it. But so I don't know. What are your thoughts on that?
Yeah, well, no, I mean, in terms of, the terminology or the definition of a bailout, I mean, you can look at it so many ways. The reason why the government reacted that way is because in '08, when they bailed out, Wall Street, the public was really pissed off, right? Because the taxpayers ended up having to pay for it. This is a little bit different twist that they're trying to use, is that, they're saying that, this is coming out of the FDIC. It's a quarterly payment that every financial institution, makes to the FDIC. So the banks are paying for it. But my argument is, if the banks are paying for it, aren't their customers paying for it? They don't just have some magic pot of gold. That's coming from customer fee income. That's coming from deposit income. That's coming from, spread income, all of that stuff to be able to make those payments. So ultimately, everybody pays for it. But I don't think really that's the point. My biggest concern is you've got the federal government now instituting fiscal policy on top of the federal policy, which is counterintuitive, which is the opposite. It's making people feel good. It's giving people more money. They should have lost it. That's not what the Fed wants. The Fed needs to see some destruction, some deterioration. I hate to say it. I think what the part of the problem is today is that people don't want to realize and understand that you've got to feel some pain for this thing to turn around. Look, the bank went belly up. Do you know how many employees they had, Mustafa?
Mm-mm.
I think it was under 10,000, maybe right around 8 or 7. So still a pretty significant amount, but that's ultimately, this is the Fed's policy working indirectly, okay, and getting 7,500 people on off payroll onto unemployment, right, and looking for work.
Like you predicted.
That's what they need. Yeah,
you predicted this.
This is exactly.
We talked about this. You said, hey, you're going to start seeing unemployment. You're going to start seeing layoffs. This is I know it's not a layoff, but it's basically the same thing.
Oh, yeah.
You're,
losing
their jobs, and there you go. It's what you thought, but then they're going back and they're flushing. So explain that difference, because you said you got the Fed and then you got the government. How are the two? I would say, becoming obstacles for one another, where one is trying to fix it, one is trying to, or I don't know if they're indirectly doing it or directly doing it. I guess the intention could be pure, but it's somewhat not improving the economy. It's not helping our situation. It's only making it worse. But we, the consumers, or the average Joes, we're not seeing the big picture.
Yeah. Well, here, let me, you've got fiscal policy, which is the policy of the government.
Sure.
Okay. They're responsible for what they call fiscal policy. Okay. The Federal Reserve is responsible for monetary policy.
Sure.
Now, fiscal policy, which is, is the government's ability to influence the economy, is typically through taxation. Okay. So look, if you increase taxes, that pulls money out of the pocketbooks of the taxpayers, which are the U.S. citizens.
Sure.
Okay. Or they can do what? What did they do in the last 3 years, Mustafa? Hand out money, right? Yeah, I mean, creating money. So, that's the responsibility of the Fed or the
Fiscal.
government.
Yeah.
The government, the federal government.
Sure.
And they're not experts in this area, so they should be treading lightly, and they have a lot of experts, right? Then you got the Federal Reserve, which controls monetary policy, another way to affect and influence the economy, except through direct monetary means, okay, where they can influence the money supply, they can influence interest rates. These are very, very key aspects of our economy. So the Federal Reserve typically has two policies, a contractionary policy or an expanding policy. Right now, because the economy overheated during COVID, right, and all the stimulus money, the Federal Reserve, through increasing interest rates as of the last 14 months, right, is contracting the economy, or they're attempting to.
Sure.
Why? Because by making money more expensive, your dollar goes for a shorter, for less, because it's more expensive. It's like, hey, when something goes up to $10, you're used to paying $5, you're going to buy half of it.
Sure.
Same thing. Money gets more expensive. People are going to borrow less, period. That's how it works. So when you have the federal government doing that, or the Federal Reserve doing that, and then you've got the federal government on the other side bailing people out, which is basically handing out more money.
Yeah.
That's counteractive to what the results of the Fed's increasing the rate is, or their contractionary policy. And so you have both groups, both institutions essentially butting heads continuously. And this isn't the first time we've seen this. Here's another thing. Big news, student loan. We're waiting to hear if the Supreme Court is going to rule for the Biden administration's student loan forgiveness, or they're going to rule against them. And what people don't understand is this ruling has economic effects. And what a lot of people will say is, it shouldn't. I mean, they're just paying their bill, or they haven't been paying their bill. This is what a lot of people have said. They haven't been paying their bill since COVID hit, so it doesn't change anything. Sure, it does.
Yeah.
Okay, I'll tell you how. Number one, if you have $20,000 worth of debt, which is the maximum, I think you can have 10 and 10. Okay, most people will only be approved for 10, but let's say you have the max of 20. Okay, Mustafa, you know how this works. If you have 0 on a credit card or 20,000 on a credit card, how does your credit look? Okay,
big
you got a lot more debt. So what does that do? It allows you to go out and incur more debt and potentially be more successful. Your probability of being approved is now increased because your DTI is lower.
Yeah.
Your debt, your debt service is way down when you remove that. The other thing it does is, from a emotional and mental perspective, it makes people think, oh man, now I don't have that $20,000 in debt. What am I going to go do? I'm going to go spend.
Sure. And they're back in the same situation.
Yep. And this is what the Fed doesn't want, though, because that's just a handout. When these people start feeling good, they're going to do what? They're going to go spend more. That's what the Fed's trying to stop.
I hate to do this. I don't even mean to go sidetrack. I'm so sorry. I've been meaning to tell you about this. I watched that Edward Bernays documentary.
Oh, yes.
As much as I have some areas where I disagree, but I do agree with one thing. We are irrational beings. Human beings, we're very irrational. We're rational to some extent, but we're very irrational. And it's that whole psychology of how they market these products, and what you just said. It's not even me thinking that I'm going to go, you know what, great, $20,000 debt just got wiped out. And then you see this ad that just keeps coming. You're like, you know what? I used to owe $20,000 and it all got wiped out. I have no debt. Let me go buy that $20,000 car I don't need, even though I have one that's free and clear. So I look at it and I was actually thinking of that Sigmund Freud, the whole idea of how we're irrational beings and somehow we need to control these irrational people. And I said, well, I kind of disagree, but I do see his point regarding how we don't always make the best decision. And it goes back to what you just said. I've seen this happen numerous times because I've been in this industry for such a long time, where you see these people that owe money and then they get cleared with the collections. They dispute these items and then collections says, hey, you don't got to pay 20. All right, pays $2,000. We'll wipe it. Don't worry. And then they get it wiped. And then these guys are back in the same boat again, all over. And I'm like, dude, you just got blessed with, them forgiving your debt, whatever you owed. I mean, still they have to report as income unless they negotiate it. I don't know how all that works, but they're back at it, and again, their credit is shot. So yeah. I totally agree with you. I think that whole student, I mean, I had debt and I had to pay for it. No one gave me a break. Most people that I know had to pay for their debt. And if you give people free things, like, you wipe their debt and you don't let them learn from their decisions, they'll never learn. That's the problem. And it would just be a domino effect. But
yeah, no, you're right. You nailed it, Mustafa. They never learn. And that's the problem, is we've become so soft. Yeah. We expect the government to bail us out individually at this point. Yeah. And it's just getting to the point of absurdity where we are moving from, a capitalist type arrangement closer and closer to socialism by the day, with all these bailout programs, and people just expect them. It's you nailed it there. It's just so absurd. But, to go back on it, you've got the Fed policy, monetary policy, sure, and you have the government's fiscal policy. Those two should be working together, so we can get out of this mess sooner rather than later. But what's happening is every time the Fed raises rates, the federal government appears to be stepping in and bailing someone out or handing money out to help people out. Like, this can't go on forever unless you want to completely destroy the country. And that's what we're looking down that barrel right now, saying, let's get this thing done, because I can guarantee you that as we get closer to the end of the year, Mustafa, with a very, very right political climate that we're coming into here shortly, that there's going to be a lot of angry people. Mm-hmm. That this is still dragging on. Remember, Americans aren't used to the economy slugging along for long periods of time. They're looking for this thing to turn over tomorrow. So you go advance, 9 months to the end of this year, and people are going to start getting lethargic and getting tired. So the federal government and the Federal Reserve, they need to start working together much more closely to remedy the problem that we have and what we're faced with the economy, which is primarily inflation driven. Yeah. We've got to get that under control. And that's the thing at Wall Street. It shocks me every day when I watch, CNBC, or I read something on Yahoo Finance. Like, these people just don't get it. There's days when the market is completely, is up 400 points, and I'm sitting here thinking it should be down 600. They just don't get it. They believe because the market is down, let's say 25%, the S&P over the course of the last 14 months, that this thing's got to start turning around. It just has to. It has to go up. Everything goes up. Mm-hmm. And that idea that the markets can just be range bound, which I don't know if you knew this, Mustafa, but they call this type of market a steer market. No. Right? You've got a bull market, you got a bear market. The steer market, if you've ever seen a steer, its horns are like this. They're straight. They're parallel to the ground. Sure. So that means that it's nice and even, and that's what is happening in the market. It's trading in a tight range, and it's seeing some blips here and there. Everybody was excited at the end of January, even some of the people that we talked to, Mustafa, because the market was up, 9, 10%. But you know what? The market is barely up. I think it's less than 1% for the year at this point. Yeah. That's how little it's moved, because it's given back everything. So anyway, fiscal policy, monetary policy, those two should be working in tandem and working together. You can't be giving government handouts while the Fed is raising interest rates and expect anything to change. That's two things that are just canceling each other out. Ultimately, Mustafa, at the end of the day, this is a result of a policy change by the Federal Reserve of increasing rates, and a bank that had a large portfolio of fixed income, mainly U.S. government bonds. So, this isn't, even if you look at Silicon Valley Bank, and we like today to point fingers, right, at whose fault it was, you really can't fault them. They used the most conservative approach, almost possible. So, you would never expect this. So what I'm saying, this isn't a systematic problem. This is a one bank problem. That's it.
Yeah.
And I think that's where Wall Street needs to understand that they have to disconnect this from, a Bear Stearns type failure that created a systematic problem. And every other Wall Street firm was investing in these derivative products. This has nothing to do with that. This is one bank's balance sheet that was affected by the increase in rates, just like the government wants their rates to affect customers, individuals, or individuals and businesses. And that's it. That's all it is. It's not a systematic problem.
Due to fixed rate bonds.
Yeah, I mean, so it's not systematic, and that's what Wall Street needs to understand. They've got to disconnect themselves and stop saying, well, this is a major problem. No, it's not. This is going to go by the wayside in a week, and we're going to continue seeing inflationary pressures. This is going to be done. This is nothing. This is a business bank. This isn't a consumer bank. It has nothing to do with consumers.
So would you be able to go into that a little bit as far as the fixed rate bonds and how that impacted them with the rates going up? Like what would they, if they weren't fixed rate bonds, what should it be? Or what would have been their, well, I guess they invested in fixed rate bonds and then rates started going up. So money was expensive. And
the value of those bonds declined tremendously, 20-30%. So when they needed to, satisfy a deposit, how do they satisfy it? That's a significant loss on the balance sheet. Every time, you got these huge, the problem is this bank was extremely profitable, okay? And this bank knew what was happening. They did. And that's the only thing you can fault them with. But what was their other option? So let's say you and I come to the bank, we want our cash, and they're like, oh, I got to sell, my U.S. Treasury bonds, and I paid $100,000. I'm only going to get 75 when I sell them. That's a problem. Right? That's a problem, because now I have to sell that $100,000 bond, and then I got to sell the other customer's $100,000 bond.
Yeah.
That's a problem. So now you're coming up short. You don't have enough cash. So you got a liquidity crisis.
Yeah.
And a lot of banks, I think, are still going to be, they will be faced with a liquidity crisis later this year, just due to the fact that, how did this start again, Mustafa? We talked about it. Risky companies in a downward trending economy are going to go out of business. They're going to run out of cash. They're going to need more cash to stay afloat. Okay, so what you're seeing right now in our markets or in the United States is a dwindling depository base. Okay, deposits are on the decline rapidly.
Yeah.
How do banks lend money? They lend money off of those assets, which are those deposits. Those are the assets on the balance sheet. They're also a liability, because anytime you and I walk into the bank, we get that money back. But that asset is what allows banks to lend 9 times what that deposit is. So for every dollar, they can lend out 9. Okay, let's say, for instance. So what happens in this case is that, all that liquidity is drying up, because all these businesses and all these consumers, with inflation, right, everything's getting more expensive. Where are they going to find the money to eat? Yeah. They're going to dry their savings accounts up. They're going to dry their money market accounts up. They're going to draw on their CDs. They're going to, early CD, what do they call it? Early whatever, CD penalty thing.
Oh, yeah, the prepayment penalty.
Yeah, CD.
Yeah.
And then, checking accounts are going to start draining them. So what's going to happen is all of a sudden the bank's going to look at their balance sheet and say, oh my God, what happened to all of our assets? It looks like customers are pulling their money. Now we can only lend half of what we could lend a year ago. Oh no, we've already lent 60%. Shut the spigot off. So that's what I'm expecting. This was also a liquidity crisis, but created by something very unique. Right? It was created by people going to pull their deposits, businesses that are struggling.
Yeah.
But what made it unique was that it seemed like all the bank's customers were struggling and pulling their money. Yeah. And the result of that was, this spreading like wildfire on social media, freaking people out, and them going to pull their money, period.
Was it 42 billion in one day?
Yeah, in 22 hours.
So 22 hours, 42 billion came out.
Yeah, I think 42, 44, somewhere in there.
So it was the balance sheet not balancing? I mean, what is it? 40? Because $42 billion coming out, that's a lot of money.
Yeah, and how do you can't
like
get
the bank, you're lending and you got your assets, you got your liabilities, and they're going up and down depending on the market. So if you have too much cash, the goal is to keep, lending out the cash, and then when you start getting low on deposits, the goal is to get more deposits by doing attractive interest rates. Yep. You're talking about like 3%, 4% on CDs, and then people start bringing the money back into the bank, and so it's interesting.
Yeah, the problem is, Mustafa, just too many deposits were locked up into these bonds. And because the bonds had lost so much value, for every dollar deposit they had taken in, they only had like 70 cents. So what happens is everyone came and rushed in because they were a heavy deposit bank. I don't know if you knew this. They had, their deposits were huge. They had like, because what it was, 95% of their accounts were not FDI insured.
It makes sense, actually, because if you think about it, the venture capitalists, they'll invest, $20 million into a company like, we're just using Uber as an example, but they're not part of this, into a company like Uber when they used to be a startup. Then that $20 million, where does it stay? It stays in that bank account. And then the bank says, hey, we'll give you a $20 million loan. Where does that $20 million loan deposit stay? That's a loan from the bank to the customer, but again, the customer gets the cash. It's available for, business operations. Now they have 40 million with SVB. That makes total sense.
I have to say, man, and remember, Mustafa, how did this start with SVB? Do you remember?
With the
Silicon Valley Bank. What was the first thing? How did this start a few days before? How did this start? There was something that happened at SVB that turned everybody onto the company, and everybody started focusing in on them. Do you remember?
Was it when they were going out to get more capital?
Yep. So you nailed it. So they were going, when was that, Monday or Tuesday? They announced they were going to go out, and try to get $2.5 billion. And it was like the market was just, they just didn't know what the heck was going on. They were lost. They were confused. And, as I mentioned earlier, this is a stock that had gone from $0 to $600 a share, back down to zero now. But, this is a company that's been the darling of Wall Street, that's been hammering out profit after profit, earnings after earnings, quarter after quarter. That Wall Street's happy with. That's the only way you go from 0 to 600, stock price. And so it caught people out in left field, like, holy smokes, what's going on? I couldn't see this. I was way out here in left field. Yeah. So, the market was super concerned, and especially a bank. Banks don't go out and raise capital like that typically. Okay, so you don't see that.
They start acting like a venture capitalist themselves. No, a startup themselves. Like, hey, VCs, we need your money.
So, the only time you see banks really go out in the open market to raise funds is if they're going to buy another bank or something, and they tell, investors, hey, we're going to raise a little bit of capital this quarter. to position ourselves to make an acquisition over the next 24 to 36 months. And, typically the market's okay with that. But in this case, it was like people freaked out.
Yeah.
And then the VCs started doing research. What's going on? Why do they need money? Then they started looking at their customers' deposits. Oh, no. And the whole thing is just like a house of cards, right?
Yeah.
One thing after the other, dominoes.
Yeah.
And it just brings the whole bank down in less than a week.
That's amazing. So
and this is a bank that I always thought was awesome too. I'm like, man, they work with high tech. They work with crypto. I'm like, this would be an awesome place to work. It's cutting edge. I don't know if you saw their salaries, but the average salary is freaking pretty high.
Yeah.
Good bonuses. So, it sounds like they took very well to take good care of their employees. Obviously, many of those employees are upset today because they unfortunately don't have a job to return to. But regardless, it sounds like it was a pretty well-run company.
Yeah.
And knowing that they, many of their assets were tied to, to the fixed income market. I mean, that's as conservative as one can get. So
is that what led them to see if they can raise more capital, because they were trying to avoid selling those bonds at a loss?
Yep, exactly. So they figured, we could raise $2.5 billion. That's plenty. It will, allow us to weather the storm.
But
right?
then $42 billion comes out.
But then $42 billion comes out because, these VCs put one and one together and they start warning their customers. So, under any other circumstance, if SVB never went out to the market to raise capital, nothing would have even happened at this point. Mm-hmm. Maybe inevitably it would have happened, maybe down in the Q3 of this year which is when I predicted this, some liquidity issues to start rearing their head. But no one expected it now, and the only reason why it did is because $2.5 billion couldn't get the money. There's concerns. The VCs are out there spreading, information, and it's just too many catalysts for the bank to stay afloat. And here we are today, and I don't think, like I said, it's going to have many ramifications beyond this. I think we still need to be focused on inflation. The Fed's still focused on inflation because ultimately, a company that had 8,000 employees and is out of business now doesn't really matter.
Sure.
It really doesn't. So, inflation's going to continue to rear its head. Fiscal policy needs to get in line with monetary policy. Otherwise, they're just going to continue dragging us through this mud. Yeah. And, we got an election year coming up. We got the beginning of massive campaigning for both, the legislative and the executive branch of the government are going to be vying for, a position. And, we're going to be running into a political climate and be dealing with a really, really poor economy, possibly. So, what do you fix?
Yeah.
This bank, like I said, was extremely conservative.
Yeah.
They can't control what's going to happen to interest rates.
Yeah.
In such a short period of time. This is such a rare event.
I think
so. There's really nothing. Yeah, but there's really not much you can fix.
Yeah.
The one thing you can do is, and we talked about this, is the whole thing about what's the Fed going to require, the federal government, that banks have a diversified portfolio? I don't know. Maybe something like that comes out of this, where a bank can't have more than 10% of its liabilities out to or its assets out to startups, right? So maybe they institute something like that. But even in our business, we talked about this, Mustafa, you and I, many times in the past, concentrations. Whether they're in your personal life, through your investment habits, diversify. Keep things in multiple places, right? Have backups. These are all common, words that are used with when you look at things conservatively. So, these banks, and I think that's why it's not a systematic issue, because there aren't many banks that are so concentrated.
Yeah. And
right?
I think and then the other thing that, we keep talking about startups, these aren't like just for people that are listening. These aren't like we're not talking about startups like a restaurant that someone opened, or down the road. We're talking about companies that are creating new ideas, products. Kind of like the Uber, the Postmates, right? These ideas that didn't exist, and then they come up with these like newer products that aren't really out in the market, or they're trying to get it out into the market. So they're pretty high risk. There's really, a restaurant.
Riskier than a restaurant.
Yeah, if you're
And
starting
they need a lot of capital. Then,
yeah,
some of these companies, they've got valuations of, 100 million, 200 million,
yeah,
$1 billion. And,
yeah,
they require a ton of capital. So,
yeah,
this isn't your, like you said, your down the road mom and pop restaurant that, does 800,000 in annual revenue. These are companies that are doing no revenue.
Yep.
And they're losing $1 million a week.
What are they called? They refer to them as pre-revenue companies? Or is that what they refer?
Pre-revenue, yeah.
Pre-revenue, yeah. Yeah, these are the pre-revenue companies that banks love to bank because the deposit size. They bring a lot of deposits, and that's the one thing that, of course, even if you're a financial institution and you have a large depositing client, what you can do with those deposits is lend it out, or do what this bank did, buy bonds. But again, that's the whole reason why. I guess that's the niche that SVB had. This is a clientele that they were able to grow with, and again, it's if that's all you have, you're kind of shooting yourself in the foot, I guess. So the learning lesson is diversity, diversify your investments, and not only on the personal level but on a business level and a banking. So
and I think when you said, you asked earlier, we were talking about, who are the losers, and I think the biggest losers really are the startups, because now you've got a financial institution that was heavily concentrated in working with startups. They were very familiar with them. They've done it for many years. They're not out of business. So where do all those, where do those VC customers that are startups go to bank? Yeah. And what's the appetite tomorrow for one of those banks to even work with a company like that? So, in terms of research and development and progress, as we like to call it in this country, that's the big loser. I think now you run into a situation where innovation slows, R&D dollars, that are allocated to some of these startup companies dry up. The capital markets become even harder for them to tap. So, that's the biggest loser, is the startups, the high-tech companies that are, hoping and dreaming that they, be able to make something, which is how everything started, right? The Apples, the Facebooks, the Intels, all of those companies at one point were a tiny startup. So to see that, many of those new startups and even existing ones will probably just fail, and many new ones won't present themselves just due to the fact that they won't be able to get financing. Those are the big losers. So, how long will it last? It just depends on the economy and what the market's doing. We'll return to a healthy economy and at one point, and that those investment dollars will once again become available for riskier businesses. But right now, people are taking their 50 grand and they're putting in Walmart. They're not putting it in high tech. That's just what it is, right? And even a lot of people aren't putting it in Walmart, as we see the market continue to bleed over the course of, I think, the last 5 days. The market's been down every day, and that's an indication of people pulling their money out and put it on the sidelines. Maybe they're putting it in their 2.5% Capital One money market. Maybe they're putting it in an 11-month CD that's now at 4.25%.
Yeah.
Right. So there's a lot of other options out there. And don't forget, we are in the middle of March, which is almost one quarter in the books for this year, and the market has yielded you nothing if you're invested in the S&P. Very little. Okay, like I said, I think around 1%. So, you can go into an 11-month CD at 4+% with pretty much complete safety and security, especially if it's under 250 grand. So, these are the options that people are looking at. And that's why you and I, we've talked and stuff about momentum and following the money. That's what you got to do. You got to follow the money. What's the next hot thing? Is it the housing market? Is it the metals market? Is it energy? Where is it? Where should I go? And right now, the hot market is the sidelines. And it has been for the last year. That's keep it in cash, man. Hold on to it.
But people are scared. I mean, I had someone say, hey, I got a lot of cash and I bank with a big bank. What do I do? I don't want to give you advice. Yeah, but, if you only bank with one bank, maybe you should diversify your assets. I don't know. I'm not a financial advisor, but I'm just saying maybe you should put your cash in 2-3 other banks. But again, that's totally up to you.
Yeah, I mean, the thing is at least if one fails, you got some cash somewhere else. Like example, Roku, we mentioned earlier had $500 million parked at SVB, which it will be made whole, it sounds like, from what the federal government's mentioned. But I think they said that it was around a little less than a third of their total cash. So, they got another $1 billion somewhere else or amongst a couple other banks. So, they could weather the storm.
Sure.
It's still tough to lose $500 million.
Yeah.
But it's not going to put you out of business.
Yeah.
So, that's smart. Have a couple banks. But anyway, Mustafa, I think that about wraps it up this evening. What are your thoughts?
Yeah, that's really good input. I think we covered it well. We'll come back together on the next session. By then, we'll probably have more news. I just got to get this thing out to the public and make sure people hear us out. And once again, if you have any questions, please leave comments and let us know. If you want to hear, if you want us to talk about any particular subject, please let us know. All right, that's pretty much it. Thank you guys for watching Under the Hood with Dimitri and Mustafa. We're out.